Hello, hi, I'm Nick Burgess, and today I'm going to talk to you about bond total return swaps. What I'm going to do is I'm going to share my screen. I'm going to take you through a presentation that I put together for you today, and I'm going to take you through bond TRS's theory and the practice. So, without further ado, let's jump in. I'm going to share the screen. Give me 1 second. Here we go. So, bond total return swaps theory, pricing, and practice. That's the theme of today. And what I'm going to do is in part one, I'm going to talk about the theory of bond total return swaps. I'm going to give you an introduction to the product. Why do we trade it? Contract specifications. I'm going to sort of talk a little bit about constant units and constant notional, which is one of those specifications. And then in the second part, we're going to look at pricing and practice with some case studies, looking at the pricing formulae and with a TRS case study example. Now, one thing to mention is if you're interested in any of my other quant research, you can find the links for SSRN here, where you find my working papers. I also have a book called Low Latency Interest Rate Markets, and that book has a section on credit modeling, and that's quite helpful for this presentation because we have a section on, in that book, we have a section on how to calculate probability of survival, which comes up in this talk. Um, for other videos, please subscribe to my YouTube channel. There's a lot of other quant material out there that you may want to take a look at. So if you want to see that, please subscribe. Now, without further ado, let's continue. So bond total return swaps. So let's talk about the theory. So as an introduction to the bond TRS, what is a bond TRS? So it's a funded purchase of a bond. So we want to buy the bond, we don't have the cash. And we receive the coupons on performance as cash flows. The payer passes these coupons and changes in the bond price. All of that's passed from the payer to the receiver, which is this arrow here. Bond coupons and performance go to the receiver. And then the receiver in exchange will provide funding plus a spread. So this is in effect the charge for a loan of sorts, isn't it? So we would have for a dollar bond, we would pay the SOFR benchmark index plus a spread, and that spread is determined by as a break-even spread, which we will discuss a little bit later. So the payer will hold the underlying bond, passes all the income on to the receiver. The bond income comes in the form of bond coupons and capital appreciation, which is the bond performance. And this means if bond prices rise, the profit is passed to the receiver. If bond prices fall, the loss is passed to the receiver. So the payer is holding some bonds, and then they're completely hedged and immunized from any movements in bond prices because all the profit, all the P&L is being passed on to the receiver. But we also pass on all the coupons as well. Now, one thing to sort of mention is that if the underlying bond defaults, then the receiver also suffers losses. So the receiver takes all the has to sort of pay the loss given default to the payer as well. So the receiver is fully exposed to all the risks of the underlying bond, but is also fully exposed to all the performance and all the gains and all the coupons as well. And they have to pay funding. So in effect, the funding is for borrowing the cash to buy these bonds. In effect. And the payer, importantly, the payer holds the underlying bonds and doesn't need to pass those to the receiver. So that's the structure of a bond TRS. Now, why would we trade a bond TRS? And what are the pros and cons? So one of the pros is capital efficiency. So it's much cheaper to buy a TRS to get exposure to a bond than to actually buy the bond itself. So if I'm a hedge fund and I want to sort of trade I want to trade, want exposure to bonds. I want to trade. I think bond prices are going up, or I think bond positions are great. Maybe even going down. I might take the opposite position and sell the TRS. But I can transact basically in fixed income markets very, very cheaply. So perhaps 10% initial margin, 25% initial margin, instead of putting down all of my capital, say I'm purchasing 10 million bonds, $10 million worth of bonds, I might only need to put a fraction down of that notional as initial margin. Perhaps 10% of 10 million, I'd be putting down $1 million instead of $10 million. If it's 5%, then I'd be putting down $500,000 instead of 10 million. And that's very efficient from a capital perspective. Now, because of this capital efficiency, we can increase our leverage. So with cash outlay. So if I have $10,000 to invest, and my margin is 10%, I can trade 10 times the size of my um, 10 times the normal size of my transaction. So and that's because of this capital efficiency, because the initial margin's only 10% perhaps. So that's a very useful feature. Um, and then the other thing that's obviously very important is that if you don't have access to that bond market, so perhaps you want to trade, say, for example, Brazilian bonds, you don't have access to the fixed income market in Brazil, you could actually approach a local bank and transact a TRS instead. So you can access markets through local brokers instead of needing to have the direct access yourself. So that's a really good benefit as well, especially if you want to trade it in emerging markets. Now, the cons or the disadvantages of TRSs, or things to be aware of, is that you are exposed to counterparty risk and default risk as well. So your bond may default, but also your counterparty default. So you might be making money, and then your counterparty default. Um, Possibly. So that so you have an exposure to counterparty risk as well, and that's because these are transactions that are traded OTC, so over the counter. They're not traded on exchange, and you're exposed to counterparty risk. Now, the other thing you're also exposed to is interest rate risk. So interest rate risk is going to affect your funding, and it's also going to affect your bond, the prices of your underlying bond as well. So it's going to affect the performance part of your TRS. Now, if interest rates go up, you pay the receiver is going to pay more funding costs. The LIBOR index will increase. So the LIBOR index, the SOFR index will increase. So your funding costs will go up. And if the interest rates go down, your funding costs go down. So you're exposed to interest rate risks in terms of the valuation of the underlying bond, but you're also exposed to interest rate risk in terms of the funding charge you'd be paying. Now we also have regulatory risk, so we're off balance sheet, and any sort of we may attract sort of increased regulatory scrutiny, and there may also be associated costs. So that's also something to bear in mind as well. TRSs. Now the other thing that's very I've seen a lot with TRSs as well. They're quite commonly used for forming ETFs as well. For money market ETFs, you might see that some of these are synthetically replicated using TRSs, whereby TRSs are quite a useful product for creating ETFs. Something else to be aware of. Now, trade features of bond TRSs. So I've got a Bloomberg screenshot here. I think the underlying bond in this case was something was Apple Corp in the US. And what we're sort of seeing, what I wanted to draw your attention to is in terms of trade features, and looking at the Bloomberg screenshot, is that bond TRSs, they're OTC products. So they're highly customizable, highly bespoke. We typically want to sort of receive we typically funding a bond purchase, and we want exposure to the coupons and the performance. But we can sort of so that's the typical sort of user case for a bond TRS. But it's also a bespoke product that can be used um, it can also be used as a structured product where you get all kinds of combinations of and modifications to the regular sort of to the regular TRS. So we can have and so there are things to be aware of. So when we're trading TRSs, we can choose to have exposure to a fixed dollar notional, or we can choose to want to have exposure to a fixed number of bonds. And so when you're I think that the natural position perhaps would be to have exposure to a fixed number of bonds, so we don't have to keep re-hedging to have a fixed constant notional. And so so we have to decide when we're trading bond TRSs, do we want to have a fixed dollar exposure, or do we want to have a fixed number of underlying bonds? And so what you'll see in Bloomberg is that you get the choice to specify whether you're trading constant notional or constant units. So constant notional means the notional is constant over the life of the TRS, and that sort of means then we may have to re-hedge the TRS, the payer of the coupons and the performance will have to re-hedge the position every coupon period just to make sure that that cash amount, that constant notional is respected over the life of the TRS. Or we could choose to have constant units, and when they say units, that just means the number of bonds. So we have to pick that up front. Now, we can we typically receive coupons and performance. It's not, which is the normal case, but in the structured product space, we might choose only to have received the coupons. We might choose to only receive the performance or both. And it's the standard case to receive both. The funding leg as well can be fixed or floating funding. It's quite common to have float funding. That's the normal case, but it's also not unusual to incorporate an interest rate swap and flip the funding from floating to fixed. So we also have to allow for that too. But it's common to have float funding, not fixed. Now we have to bear in mind that we're exposed to interest rate risk and credit risk, which we mentioned earlier, and we also mentioned that the receiver is exposed to loss given default should there be a default. Performance projections, the funding of performance can be linked to repo rates, which we'll come on to shortly. And then we can also choose to have the performance paid with the coupons, or we can choose to have the performance paid at maturity only. So that there's a choice. There can be a choice of how performance is paid. It's quite normal to pay performance at the same time as coupons. Um, but it's also not unusual to pay the performance at maturity. Now, if we choose to pay performance with the coupons, those regular performance payments, they reduce the potential future exposure of our trade and reduce XVA costs and credit valuation costs, because instead of accumulating a very large, potentially a very large performance payment until the end of your TRS. And running sort of the risk of counterparty default, we could choose to restrike the performance sort of aspect of our trade and reset that every coupon period, and that would reduce the PFE exposure and reduce the credit costs. So that's quite a useful. That's quite a useful feature just to choose to receive performance with your coupons instead of receiving one big lump at maturity. So that's something to be aware of in terms of reducing your XVA costs. Now, in terms of an example trade booking, an example sort of contract specification where I try to simplify the booking and just make you aware of how to book this trade and what features you can have. Here's an example where we buy 50,000 bonds. The US Treasury, so we specify the underlying bond here as a US Treasury paying 6%, 15th of February 2026. The price is 104.54.33 is the typo there. So you can see the price is 104.54.33. That's the traded bond price at inception. And we need to know that price so we can work out the cash equivalent, right? So I've specified here that I want to have an exposure to 50,000 bonds. So I'm specifying I want exposure in number of bonds, not cash notional. So I specified the notional type in units, and the cash equivalent then would be 50,000 times the face value of 100 times 104.54.33, which is the traded bond price at inception. And that would give me a cash equivalent notional of 5,227,165 US dollars. So in this case, I was specifying the bond leg as a number of bonds or number of units. Now, coupon payments, I've specified to have coupons and I'm expecting coupons and performance. So I've selected coupons and performance here, not just which could be coupons or performance, but it's very common, mostly common to sort of see coupons and performance together. That's the standard case. Funding is float funding here, SOFR funding plus 100 basis points. In this case, it's an arbitrary example chosen here to pay performance at maturity, and we're paying coupons on coupon dates. It could choose to have coupons at maturity as well. Because it's a highly structured product, you can do anything. But the standard TRS is to pay coupons on coupon dates. And typically we would pay coupons on coupon dates too, but here we've chosen at maturity. Now, we want to mention that it's a credit risky product, so the cash flows are scaled by the survival probability. So you'll see me sort of saying here, is credit risky true? That just means that the bond leg or the funding leg can default. So if I say it's credit risky, it just means that I want to incorporate the probability of survival into my calculation. And then we also need to mention that if there is a default, then the receiver of the bond coupons will need to pay, will suffer the loss given default, and will need to pay that to the to the payer of the bond coupons. So you see me here reflecting include loss given default true. Now this is just how I'd book the trade, and it's and we assume is the sort of contract specifications typically assume that for uh, developed countries for senior debt is specified as having 40% recovery across the board. That's an assumption that's specified in these docs that everyone adheres to. So we've got a recovery rate of 40%. And you can see here the credit curve is US dollar treasury for pricing, and the discount curve is the SOFR curve. In this case, we could use a repo curve in some cases, which we'll mention later. Now, coming on to the trade feature where we talked about where we could specify constant units or constant notional. I want to sort of show you how that affects the coupons and the calculation and the pricing of the bond TRS. So constant units, we can specify, do we want to have exposure to a fixed number of bonds, constant units, or do we want to have exposure to a fixed dollar notional dollar amount, which we specify as constant notional? So in the constant unit case, we fix the number of bonds, and that means that the notional is varying over time. So as this bond price is changing, our notional is changing, and how we calculate the cash notional in the units is this formula at the bottom. So when we pick a constant unit, the cash amount is moving, and the way you calculate that is they take the number of units, you times it by the bond price percent, and times it by the face value of 100. And that will give you the notional, which is the reverse of this units formula here. So if you know the units, you can work at the cash notional, and if you know the cash notional, you can work at the units. You just reverse this formula. Now, every period when you select constant units will potentially have cash notional exchange, and bond price fixings are required. So you see the fixings here. We need to know that to work out what the notional is, you need to know what the bond price is for that time period. So you would do units times bond price fixing for that period times 100, and then you would get bond price fixing, by the way, in percent times 100. And you can see an example calculation sort of down here if you reverse engineer this. Now, so what you can see is that when you fix in this case, you can see the bond units are fixed for every coupon. So you can see this is constant, and then you see that the notionals are varying because the bond price is varying. And because of that, you'll have a notional exchange every coupon period potentially. So that's what we're observing here. Right now, so the units are calculated as the cash notional divided by the face value, which is of the underlying bond, which is typically 100 times the bond by the bond fixing. Now, if you do that for a 10 million US dollar notional, with a bond price of 123.86, you get the 80,077.36 as the number of bonds, and that's actually going to be the constant in this bond units is going to be constant in this case. Now the coupon, the Bond TRS coupon, is always sort of calculated from units, or that's typical how we calculate the coupon, and it will be units times the face value times the bond coupon rate times the year fraction. So in this case, the first coupon would be 80,736 times the face value of 100 times the bond coupon of 3.85% times 0.5 because it's semi-annual year fraction, and that will give you the US dollars 155,416.8, which is this number here, which we see rounded. Now, because we have a fixed number of units, because it's a fixed bond with a fixed rate, and the year fraction for this particular bond is always 0.5. That's why we have the same coupon for the entire life of the bond. Now, if we had chosen to have constant notional, then these coupons would vary, which is what we'll see shortly. Now, the constant notional case is the other case where we've chosen 10,000. We want to have a $10 million exposure to this underlying bond, and so you see the notional is constant. There are no notional changes over time because there's no change in the cash value. But what is changing is the number of units. So as the bond fixing is changing, in this case, the bond units, the number of bonds is changing. And we calculate the bond units in the same way, and we calculate the coupon in the same way. And we'll see the first coupon is the same because we use the same bond fixing. And then as over the life of the bond, as the fixing changes, the coupon changes, which is what you're. So here we see I have a fixed coupon, and here we have the coupon varies. And we just follow this calculation in both cases. So the coupon is units face value times the bond coupon rate times the year fraction, and then that's this number, which you'll see here. Now these numbers are exactly match Bloomberg, so that's reassuring. So just so you're aware, these numbers have been fully reconciled against the Bloomberg trade venue. Now, in terms of pricing and practice, let's have a look. Let's have a deeper dive at how the pricing formula work, and we'll give you an example at the end as well. So the Bond TRS has three main components. You're going to be paying. There's going to be a payment of bond coupons. There's going to be payment of bond performance. There'll be a funding component, and we take the present value of these components. So the present value of the TRS is the sum of discounted cash flows coming from these three components. However, there's one caveat. This is in the case of that the bond survives, but the bond may default, and we have to incorporate that too. So, however, in the event of a bond default, the TRS will be unwound immediately, and the receiver of the bond coupons must pay the loss given to default to the bondholder, to the payer. So the loss given default must be included in the PV calculation. And typically, what we do is we make an assumption, which is very common in all credit markets, that senior subordinated debt in developed markets typically will sort of define that that will assume a 40% recovery rate. And so the loss given default will be 60% times face value times the notional of your transaction. So that's quite a large loss that you would take, potential loss that you take if there was a default, and that is discounted as well. And we look at that component of the that fourth special component as well. We'll take into account into this pricing formula. Right. So if we look at an example in Bloomberg again. So in this case, we've got constant notional of 10 million US dollars. I believe this is the Apple bond again. And so we look at the three components for when there's no default, and then we'll look at the default case at the end. So the Bond TRS PV, the three components we would need to look at would be the PV of the bond coupon, the PV of the performance, subtract then the PV of the funding cash flows, which is the second leg. And then we have this phi indicator function here. So we have a +1 when we're receiving and -1 when we're paying the bond coupons. And we just need to flesh out then how to evaluate each of these components, which we'll do next. Right. So the pricing the bond coupons. So if we need to bear in mind something important, that when we're pricing these different components, we need to pay attention to the notional. So when we're pricing the bond leg, we typically want to work in units, bond units. So there's 80,734. When we're pricing the funding leg, we want to work in cash terms. We always work in cash terms on the funding leg, but we may have a constant notional or constant number of bonds on this leg. So you have to pay attention to these, to notional. So on the bond leg, we're working in units, typically in bond units, and on the funding leg, we're working in cash terms. So to avoid not getting confused by that. So here you can see we're looking at the number, the bond notional. That's the units times face value, and this gives a coupon of bond notional times rate times year fraction, and leads to and then in terms of the PV, the present value, we take the coupon, which is bond notional times the rate times the year fraction, and this is the coupon rate of the underlying bond. And then we need to multiply by the probability of survival, as in the probability that you're going to be receiving your coupon, times by the discount factor, which gives you the cash flow value in today's terms. And you put all that together for every bond coupon, and you take the bond notional, which is units times face value, times the coupon rate, times the year fraction, and then you multiply by the probability of survival, and you multiply by the discount factor. Now, in terms of terminology in financial literature, it's very common to denote the discount factor with the letter P, and it's very common to denote probability survivals with letter Qs. So that's quite standard terminology, just so you're aware. Now, in terms of pricing the performance has the largest impact on the TRS PV, because a 1% change in bond price, you're going to be paying 1% in a single coupon period times your face value of 10 million. So that'd be $100,000. A 10% move, $1 million. Whereas a 1% move in rates or interest rates um, isn't going to be as large. So, but bond performance has probably the largest impact on the TRS PV. The performance captures the change in bond price using bond fixings or resets. Um, and the change of bond price for each coupon period, we look at that, and that's the price at the end of the coupon periods minus the price at the start of the coupon period, so the price surprise. And we want to sort of calculate the PV for that. So you take the bond notional, you multiply it by the change in price, and then you multiply by the probability of survival. That's the probability that you're going to receive that cash flow, and then times by the discount factor. And there's two sort of flavors of this. We can pay if you're paying performance every coupon period, then you're going to have n coupons, and you're going to sort of see incremental bond price changes over each coupon period, multiplied by the probability of surviving and the probability of the discount factor. So basically, this formula will be repeated for every coupon. And when you're paying your performance at maturity, you're just looking at the change in bond price over the entire life of the bond for your TRS, over your TRS period. So at the start of the TRS, the end of the TRS, and then multiply by the probability of survival and the probability of discount factor. Now, this is obviously going to incorporate, this could be very large. If you're holding a TRS for a long period of time, you may have a big movement in the bond price, and it's percent times the dollar notional of your TRS. So that could be a very large movement. That could be a very large PV, and that's why there could be a large sort of credit valuation charges associated with this potential future exposure. So opting for the restriking your performance, resetting your performance PV every coupon period is obviously going to reduce that charge. But the choice is yours when you're transacting. It's a highly bespoke transaction, and there are two ways of pricing the performance leg. Right. Now, we want to talk a little bit about, well, how do we know when we're pricing? How do we know the future values of what the bond future values are going to be? So we need to know we want to price the TRS today, but to be able to price the performance leg, you kind of need to know, well, what are my bond prices in the future? So how do we estimate or project these future bond prices? So it's very common the standard approach is to use risk neutral pricing. And what that means is we look at the remaining sort of cash flows of the bond that are within the TRS period. So if I have say a 10-year bond, but my TRS is for 2 years, I look for the next 2 years. I would price the remaining 2 years worth of bond cash flows and discount them by risky discount factors. And risky discount factors is just a fancy way of saying it's a discount factor where we multiply by which incorporates the probability of survival. And we'll talk about that a little bit more in the coming slides. So if you want to sort of work out what is the future value of a bond, you look at the remaining bond cash flows and that are in the future within the period of your TRS, and you discount them. So it's pretty straightforward. Now, one thing to mention is that when the payer of the bond coupons and performance, if they don't actually hold the underlying bonds and they're actually borrowing the underlying bonds in the repo market, it may be appropriate to use risk-free discount curves that are built from repo rates. We still need to include the credit spread, and it might give a better sense of actual funding levels. Repo curves tend to be short-dated. They might only be useful for pricing short-dated TRSs. But the interesting thing is quite a lot of TRSs are sometimes just for 3 months. And it's quite common to have a 3-month TRS and you just keep rolling your exposure until you're ready to unwind that exposure. So it's not unusual to have TRSs that are long dated, but it's also not unusual to sort of see people taking perhaps a longer view on bond exposures, but maybe just trading a 3-month TRS and rolling the position until they're ready to sort of exit that position. So it's quite common that you see short-dated TRSs, and in those cases, perhaps using repo curves for the risk-free discount curve might be appropriate. So that's something to think about. Now, when we're pricing the funding leg, the client borrows funds to purchase the underlying bond. The notional of the funding leg is typically constant. It doesn't tend to vary. It doesn't vary with the notional of the performance leg of the bond leg. So the funding leg has a cash notional. I denoted here NC. This notional is not the bond unit, so please be careful not to mix up, to put the wrong notionals on the wrong legs. So please don't confuse this with the bond notional NB. So let's assume we have a funding position in dollars using SOFR. So we would fund the position. We would be paying funding using the SOFR benchmark index, the SOFR floating index plus the spread, which we denote F plus S here. So funding plus spread. And then the funding cost would be or float coupon would be calculated as the cash notional times SOFR times plus the spread times the year fraction. And the PV would be that floating coupon sort of multiplied by the probability of survival, as in you will be sort of making that payment, and times by the discount factor. And if you put all that together for every each and sum up the PVs for each of the coupons, you have the cash notional of the funding leg times the floating index plus the spread, year fraction, and then multiplied by the probability of survival and the probability, and then multiplied by the discount factor. So it's just simple sort of linear calculations. That's quite nice. You sum them up and then you get the PV of your float leg. And now we're going to put all that sort of together. The price of the PV of the TRS is the sum of these components is the bond coupon plus the PV of the performance plus the PV of the funding cash flows. And then we sort of have long short indicator here with this phi, plus one we're receiving, minus one we're paying bond coupons. And when you sort of substitute in all these, all the different formulae we looked at, we get this expression. And now what I do on this next slide is there's when we want to sort of use the risky discount factor notation, which sometimes you'll see formula quoted like this, but sometimes it's convenient. So these are the components of the TRS, the pricing components for when the TRS is surviving. So all these Q terms are probability of survival. So they incorporate probability you don't receive these coupons. So, but there's a very convenient notation here we can use. So cash flow that can default is said to be credit risky. And to compute the PV of credit risky cash flow, we must multiply by the discount factor and the probability of survival, because it's not guaranteed you're going to receive your cash flows. And so when you're multiplying by the discount factor and the probability of survival together, we can combine those terms. We just have one term, and so we take the Q and we take the P, multiply them together, and then we donate it with P. In this case, with P tilde. Sometimes you see P hat. And we call that the risky discount factor. And it just means the discount factor scaled by the probability of survival. So when we're looking at the cash flows that are dependent on survival, we can use this risky discount factor. And so the formula is exactly the same, but we just use this P tilde instead of writing out Q's and P's separately. So just to make you aware of that notation, in case you see it in the literature. Now, the other thing, we haven't included the loss given default, so we just add that on. If the bond defaults, the TRS is unwound, and the loss given default is paid by the bond coupon receiver. We must incorporate this, the loss given default, and it's defined as the number of bonds times 1 minus recovery rate, bond notional rather, times 1 minus recovery rate, and RR is the recovery rate of the bond. Now, in developed markets, the recovery rate is assumed to be 40%, and that's defined in the ISDA master agreements, and that's 40% for senior subordinated bonds, and at least 20% for the unsubordinated bonds and for emerging markets. Now, the probability of default during a coupon period, so this is different from the probability of survival. It's the probability of surviving to the beginning minus the probability of surviving to the end, which is Q to T I-1 to Q to TI. And so if you take the difference in surviving to the start minus surviving to the end, that captures the probability default. And that's this expression down here. So this minus term at the bottom. So we've got our bond coupons, our bond performance, our bond funding cost, like what we saw on the previous slide. And now we've got this extra term, which is the loss given default. So we've got the bond notional times 1 minus the recovery rate. So that's going to be recovery rate for US Treasuries, for example, will be 40%. So 1 minus 40 would be 60% times um, the notional, and then multiplied by the probability default, multiplied by the discount factor. Now, the reason why we don't use P tilde in this case is because P tilde is capturing probabilities, risky discount factors capture probability of surviving, and this one's capturing probability default. So we can't use P tilde in this case. We actually have to write it out. So just making you aware. So the loss given default is bond notional times 1 minus recovery times the probability defaulting times the discount factor. And you add that on, and then you have a complete TRS pricing formula. So that's quite a lot of work to get to that point, but I wanted to take you through the components properly because it's quite a tricky product. Now, one thing to mention is, which we haven't talked about yet, is how do we come up with the spread that we're going to use in our transaction? And so what we typically do on inception when we're pricing TRS is we quite often want our TRSs at inception to have zero PV. So there's no, and that means that that the bond leg and the funding leg, they're equal, and the way that we make them equal is by picking a spread to make that happen. And it's not unusual to put some commission inside that spread, but we're talking about the spread in this case without the commission, which we don't know. I mean, every kind of party would be different, but the fair sort of break even spread or par spread, we calculate it this way. So it's going to be the funding spread that makes the TRS price to zero at inception, price to zero or par. And that means both legs have equal value. And to calculate the par spread, we rearrange the pricing formula and solve for the S parameter. We often rename that S parameter to P. So we rename the spread to P, meaning par spread. And it's computed as follows. Now, we say the par spread is the price of the PV of the TRS with no spread divided by this term. Now let's have a quick look at this formula. What we've done is that we've rearranged this PV formula. We say we want the PV to be zero. So we set this to be zero. And we find, well, what's the spread that makes that happen? And so what we do is we factorize out this S term here. This is the spread. It only comes up in the funding leg. And so if we take out the spread and we factorize it out, we have spread times the cash notional times the year fraction times the spread, obviously, and then multiply with this risky discount factor. If you factorize that out, we get spread n tau p tilde as a separate term. And because there's a minus sign, we could take it to the other side, it'd be plus. And so what we have on this side, we'll have the PV of a TRS with no spread, which is this part here. And we factorize this spread term onto the left-hand side into positive. And the terms are n, tau, and p tilde, and that's the risk. That expression is called the risky annuity, which I'll show you here. So there's the factorization. We just divide by those terms to get the spread on its own. So all we've done is rearrange the formula, and it looks pretty daunting, but we just factorize this S term. That's all we've done, and we rearrange, and we get this formula. Now, these terms on the bottom in the denominator, they're called the risky annuity. That's basically that's the same as pricing a fixed leg with a notional of 1. And so that's very common. So annuity is very common in interest rates. It's actually a tradable instrument as well, but risky annuity is exactly the same thing in the credit space, except that we're using risky discount factors. So we're saying this is the annuity where there's a probability of survival inside the discount factor, and it basically represents a fixed leg with a rate of 1, 1 representing 100%, and that's why you don't see it here because the rate's 1. So that's just some background around what this term means. And so we're able to sort of calculate the break-even spread as the PV of a TRS with the spread of 0 divided by the risky annuity of the float leg, which is this term here. So that's some mathematical background there. So we can use this formula. We'll calculate the par spread. The pair of the arranger of the TRS may add some small adjustment on the spread just to add commission, but the fair break-even spread is calculated this way. So that's quite a useful formula to have. And then the last thing to sort of mention is how would we approximate the price of a TRS? So if you look at I'll give you a toy example here, and it's a very convenient sort of rule of thumb for how we can sort of price the performance leg of TRS. So the funding leg is very straightforward to price. So we can price those very it's those are very straightforward. But what's not so straightforward, perhaps, is the how to price the bond coupons and performance. And so if I in this example I've got here, I've made a very toy example. I've got a 10-year bond, it's paying coupons of 5%, and it's got a notional exchange of 105 in the future. We don't show the 100 at the beginning, it's standard practice not to, because it's considered in the past. And what we're doing, if we want to sort of price a bond, is that we would sum up all these cash flows. Rather, we would scale each of the cash flows by the discount factors to get them in today's to get the PV of each coupon, and then we sum up the PVs and we get this 10811. That would be the price of the bond. Now these discount factors, they're risky discount factors. Now, so that would be a 10-year bond, say 10811, based on current discount factors. Now, if we had a TRS for 2 years, paying annual coupons of 5, you would receive if you wanted to price just the coupon part, we'd just do some discounting. We would scale our five coupons of 5 by the discount factor, get a PV, sum up all the PVs for each of the coupons, 9.43. Now, performance, I mentioned earlier, in this case, if we're paying performance at year 2, the performance is going to be whatever the future price of the bond is, minus the current value of 10811. So I put the 10811 here because this performance payment's being made on year 2. It's being paid at maturity in this case, and the future value of the future price of the bond is we can compute that from risk neutral pricing. So we just sum up all the cash flows in the future to get the future price of the bond. So we got 5. So you can see I've dropped off the 5s from time period 1 and time period 2, and I'm just looking at the 5s going out as far as year 10, the maturity of the bond. And if I discount all of those and subtract off this the initial bond price, I get the performance. I get the PV of the performance in today's terms. So this is all discounted back to time 0. So if I add these two things together, I've got my bond performance leg, I've got my bond leg, I've got my coupons and my performance. Now, how would I represent that from a cash flow perspective? From a cash flow perspective, what we did in effect was we priced all the cash flows of the bond and we inserted a bond fixing at the on the payment date of the performance. And that's all I've done is basically we can back of the envelope price the bond leg of a TRS as the price of a bond, and where we add on the fixing, but we have a minus value. We have a minus fixing at the time of that performance payment. Now, what we've done here, so that makes it very simple. All I do is I price a bond and insert bond fixings obviously with negative values. Now, one thing I've done here is I haven't included the probability of the loss given to default. But we could sort of say, if for investment grade bonds, we could sort of assume the probability of default is close to 0. Maybe that's not a large number as an approximation. And that would give you an approximate back of the envelope sort of price of a bond TRS. You price the bond and you subtract off the fixing at the appropriate time of where you're making that performance payment, and add it all up. And discount it, and you'll get your price of your bond, and you'll match the price of a bond TRS for the bond leg. So that's a very good. I think that's a very useful approximation for the bond leg of a TRS. So we looked at quite a lot of things today. We looked at the theory, the price, and the practice. We introduced the bond. We talked about why we trade TRSs. We looked at the bookings and the specifications, the formula, and we had that approximation example at the end as well. So I hope you enjoyed the discussion. Please subscribe to my channel, and thank you very much for your time.